what does all this mean? No longer is all debt bad in retirement. And I started saying this at the front of my conference speeches, because I'd love to see the reaction in the audience. The first time I ever did it was at an FPA national conference for the Houston chapter, largest chapter in the nation, and I watched about 150 arms cross in the room when I stated this, and I'll say the same thing to you that I said to them. Don't get me wrong. I'm not saying it's not ideal to be debt free in retirement. However, if we're going to exclusively make retirement plans around ideals, then we should wait until all of our clients have $200 million in the bank, because that would be ideal too, right? Now, as ridiculous as that sounds and is, the reality is we have proof. We have peer-reviewed, published study proof that you can be smarter with your home equity. And yes, it just happens to use a debt instrument to get it done. So what we're talking about is a paradigm shift for financial planning, right? We're talking about a new way of thinking about debt. Sure, most debt is bad, but if you think of it this way, consider that you may not really have any retirees as clients. That the definition of retiree is wrong. And I would propose that there are no retirees. You simply have people that have shifted their career from being a professional, whatever, doctor, lawyer, attorney, whatever it was, right? Plumber, restaurant owner, doesn't matter. They've shifted their career from that to being a professional investor, being in the investment business. And because they have no experience and business running an investment business, they hire a financial advisor, a manager of that business, to do that for them. Now, as a business owner, here's where I'm going to tie it all together. You don't sell off part of your company and bring in another partner just to raise capital to replace the kitchen equipment in a restaurant. No, you would be smarter with that. You don't have to give up your equity to do that. You take out a lease or a business loan, maybe an SBA loan, something like that, right? You take out smart money at a reasonable interest rate, and you retain all the ownership of your business. And being a retiree is not unlike that. And you're going to see why in just a moment, right? So there's a smart way to use debt, is what my point is, in retirement. So let's start with the coordinated withdrawal strategy, a new discovery in risk reduction. Yeah, we can actually use debt and reduce risk substantially. So what if you could safely increase a client's withdrawal rate, create significant portfolio growth, and substantially reduce risk all at the same time? It may sound too good to be true, especially if you're a planner, but the reality is a new study shows that a coordinated withdrawal strategy can do all this while reducing the impact of volatile markets by 7 times. So let me add another what if. I'll cut kind of to the chase, and then I'll back it up. The average retiree in their life and retirement, let's say 30 years, is likely to experience 4 down market years in that 30-year period, right? That's just the statistical average. Imagine being able to wave a wand and make the impact of 3 of those down market years, 3 of the 4, go away like they never happened. That's what this withdrawal strategy could do. So who is it for? Financial advisors with clients that are in the mass affluent category. Now, the most common definition, there's not one that's hard and fast, but the most common definition of mass affluent is they have $500,000 to $1.5 million in investable assets, not net worth, investable assets, right? So I am going to broaden this out, and rather than go through all these other people that that can benefit from this strategy, because it's the mass affluent plus all these others, right? Simply look at everyone with 2 million and less in investable assets. Probably 2.5 million and less in investable assets. And then you're going to be in the ballpark. You're going to be dealing with the people that this strategy can help. So if you want to look at the documentation around what I'm about to explain, it's in the Journal of Financial Planning, the December 2021 edition. And if you are a FPA member, my understanding is you can still log into that study, read it, answer 5 questions, which you'll probably be able to answer just out of this webinar, and get an additional CE credit for free, right? My understanding is that's still there. If not, call the FPA. So normally when we introduce a new strategy, most of the time it's compared against a standard typical forward-looking market, right? And the typical market is what? S&P up 5-6%, something like that, right? Doing a lot better this year for now. But rather than do the typical scenario, we ran over 10,000 Monte Carlo simulations on this withdrawal strategy, and it performs so incredibly well that we demonstrate it against a worst case scenario. And then you can just assume that every other outcome is going to be better. And wait till you see how it performs against a worst case scenario. That worst case scenario is sequence of returns risk, right? Down market years, hitting the retirement plan early in the plan. Worst case scenario, first 2 years of retirement, right? That is a devastating, unlikely, but always possible scenario that we have to be prepared for, right? Why? Well, think of your journey in retirement like a plane flight. What's the most dangerous part of a plane flight? Takeoff and landing, right? And so, you know, from a retirement standpoint, when sequence of returns risk happens, those down markets early in retirement, it's like finding out that you don't have enough fuel shortly after takeoff. Now, in the grand scheme of things, a 30-year retirement, that's like, you're 2, 3, 4 years into retirement, and now you find out you don't have enough money to fund all the way to life expectancy when you factor in things like compounding inflation, right? The math doesn't math, as they like to say. And so what do? You can't go back to your employer you left 3, 4 years ago and say, I want my job back. I need to make money for a few more years. You got replaced years ago, right? So likely you can't do that. So you have to avoid it, right? You have to prepare for the worst case scenario. So there are 2 options. You can use home equity as a last resort, and this is what most people think you do, right? They think only use your home equity as a last resort. And when most people think you should do something, that's generally what not to do, right? That's why we have so few rich people in the world. And generally they're not doing what the common person does, right? Or you can use home equity as a strategic retirement alternative income source and coordinated withdrawal strategy that increases portfolio longevity. Let's look at a scenario. We're going to use the average American, and you can just round this up, to the typical client you might run into, but we're going to simplify things so you can remember it. Average American peaks in income at $75,000 a year. And when they contemplate retirement, they plan on living on 70% of that. So let's say $53,000 a year, right? And their logic is if they pay off all their debts, they pay off their house, their credit cards, their car loans, they're debt free, they can maintain their lifestyle on 70% of their peak income. And they're actually not off by much. It's the investment side that they're usually wildly off on. They also tend to think that they can maintain a 10% average return on investment after taxes for their entire life in retirement. And that people gasp when I say that, but that's what the average American thinks they can do in retirement, right? So they're not only not planning adequately for long-term care, they're not even planning their retirement income right? That's why they all need but can't afford financial advisors. So with that said, we're going to use a couple that just retired. They have a portfolio of $400,000 of uh, I think this original scenario was done on your standard 60/40, and inflation adjusted draws at 3.5%. We're using a 3.5% inflation rate. I know that's a little bit low right now. I always use this, and when I started using it, it was high, and now it's low. Um, they have 27,000 annual Social Security income. I'm actually going to take a second and get my pointer working here. That'll help the flow. There we go. 27 in Social Security income in year one, beginning of retirement. And again, their goal is to maintain a lifestyle that costs $53,000 a year. So, with that said, let's look at their life in retirement with that plan, using home equity as a last resort. So, here's their age. They happen to be the same age. We're going to use actual market data from 1973. Why? Because everyone that retired in 73 experienced a major sequence of returns event. Annual portfolio draws are in this column. Can you draw quarterly or monthly? Yes, right? But we are trying to do this in a couple of slides and not 20 of them. Reverse mortgage line of credit draws. This is the tool in this scenario that we're going to use to access the home equity. The home equity is doing the work here, but the reverse mortgage is simply a tool. Why the reverse mortgage? Because it doesn't require monthly payments. It's the best when it comes to cash flow, if that's your only concern, right? We have a new tool that I'm going to demonstrate in a moment that it performs better if you're more concerned about legacy goals. Okay, so there's different tools depending on the outcome that your client is looking for. In this case, we're going to use a reverse mortgage to access that home equity when we need it. Here's portfolio value at the start of each year. The reason this isn't 400,000 is because, look at the math, they took out 26,000 on day one. This is portfolio performance as a percentage, portfolio performance as a dollar amount. Here's portfolio value at the end of each year. And then this is what the assets under management fee would be if it was a flat 1%. We just used 1% as an easy calc number, and then you can see the impact on advisor revenue. So since this is home equity as a last resort, we don't touch home equity until when? Until we don't have a choice, until the portfolio is completely exhausted. And so then we move over and start living off the home equity for the remaining years. And keep in mind, this is a great illustration of compounding inflation. All this client did was maintain their lifestyle. And in that last year, it cost $70,000 to maintain the exact same lifestyle they had 30 years earlier at the beginning of retirement. So what's the result of what most people think you should do? Well, the portfolio was exhausted after 25.2 years. Portfolio value is zero. They're no longer a wealth management client. There's no portfolio to manage. And then the total fees have now ended, and they ended up at just over $83,000 over the life of that relationship. Okay. So, and no ongoing revenue for the advisor or the firm, right? So what is this amazing withdrawal strategy? It's so ridiculously simple. You're going to wonder why nobody ever thought of it. It's not that no one ever thought of it. It's that we refuse to consider using debt to do it. So step one, establish the HECM line of credit prior to the first day of retirement. Now, can you do this with a jumbo reverse mortgage? Yes, the HECM is the FHA version. Stands for Home Equity Conversion Mortgage. And it works just great for this. Step two, now, can you do this later in retirement? Yes, absolutely. You don't have to do it on day one. You're going to get the most bang for your buck if you do it on day one, right? Step two, evaluate portfolio performance at the end of each year. Something you're going to do anyways. Was I up or was I down? And if the portfolio value has gone up, then nothing changes. You keep drawing on the portfolio for the next year. This is just a once a year check-in is all it is. It's super easy to do. But when the portfolio has gone down, what you're going to do is give the portfolio a break for 1 year and not take a draw, but you need to live off of something. So instead, you're going to take a draw of the home equity via the tool of the reverse mortgage, right? So what does that look like? Coordinated withdrawal strategy. So on day one, they take out their 26,000 just like before. 12 months go by and boom, here's a down market. So that's our trigger. So now we are going to take our draw from the home equity. Year two, another 12 months go by. And once again, we're going to take a draw from the home equity. And then now the market's back up. So we go back to drawing on the portfolio. We keep drawing on it and drawing on it, even in the slightly up years. We just stick to the plan. There's another down market here, another one right at life expectancy. In total, per the normal average, 4 down markets, so 4 draws on home equity, that's all. 26 draws on the portfolio, that's still the workhorse. But look at the difference in outcome. Instead of running out of money in their 80s, they leave over $1 million portfolio to their heirs. We're not talking about a little bit of improvement. Oh, this will get you a 20% bump. No, this is a massive difference in outcome. 0 compared to $1 million. So what's the result? Portfolio success, it's more than doubled. And the fees collected by the advisor in the firm, 2.5 times revenue. And ongoing. Most likely this client is, their heirs are going to continue with that advisor and firm, right? Because there's something to manage and it's been a success. Let's look at the net impact. Home equity is the last resort versus the coordinated withdrawal strategy. We've got 0 portfolio over here, doing what most people think you should do. Over $1 million portfolio over here. Then we project out our home value at just a 4% number. If you think your market will do something else, plug it in. Mortgage payoff, 511 over here, 643 over here. And this actually, as we randomize this, sometimes this flips. It just depends on the sequence of returns, right? If you didn't get hit quite so early, maybe spread out those first 2 hits at the 5 and 6 year mark, then this is going to flip. And you'll actually, on the coordinated withdrawal strategy, have a lower payoff. And then total estate value, here's the bottom line. 1.4 million of home equity only left to the heirs, no portfolio, versus almost 2.4 million left over here. Which one do you think the heirs would rather have? Right? And which one do you think the client would feel more financial stability? Right? And then advisor revenue. Okay, we already talked about that. So you end up with a win-win-win using the coordinated withdrawal strategy as documented in the Journal of Financial Planning. So inevitably, I'm asked, Phil, what about RMDs? We've got to take our required minimum distributions. Well, that's correct. And in the month that you take that occasional RMD, you're going to, when you take income from the home equity, you're going to take the RMD and simply deposit it, keep it invested by depositing it into a mirrored taxable account. So you're just going to set up another account with the same investment mix and keep the money invested. And yes, there's some minor tax consequences with that account, but because it's not tax advantaged, but they're incidental, right? You're still going to get the overwhelming benefit of the strategy. So here's an illustration from the study. And this shows a couple of things. So here our blue line started with everything else. They didn't make any skips in draws and they ran out of money, right? The orange line, this will answer the question about can you do this later in retirement? They didn't take skips until late in retirement. They took 2 skips on down markets late in retirement and had a substantially better outcome. They left 300,000 instead of nothing. And then in the gray line, they also took 2 skips, but they only took the 2 early skips and had an even better outcome. And so this illustrates a few things. One, can you do it later in retirement and have a benefit? Yes. And then it also illustrates the compounding effect of these skips and why the earlier you do it, the sooner you do it, the better, right? And so you end up with a withdrawal strategy that brilliantly offsets compounding inflation. One of our number one worries in drafting a retirement plan is outpacing inflation, right? And this does it. Obviously, the gray line, this person would have the opportunity to take the two later skips and have an even better outcome. So let's compare this to other things we do to reduce risk. We apply asset allocation, right? We don't have all of our eggs in one basket. We've got some in cash, some in stocks, some in bonds, maybe some in commodities, maybe some in crypto, who knows, right? Why do we do that? Because it reduces risk, and if we do it right, we get the same reward. So there's a fiduciary implication here, right? That why take on unnecessary risk when you can get the same reward with less risk? Same thing with investment diversification, right? We take the stocks now and we diversify further, and we put some in domestic and some in international, some in tech, right? Some in we just spread it out all over the place. Why? Further reduce risk and maintain the same reward, right? Both of these are out of modern portfolio theory of 1952. But now we can add to that a withdrawal strategy that reduces risk substantially further, the risk of cash flow exhaustion, which is what our clients live on, and dramatically increase gains. And where this flies in the face of what we do and what we expect. Normally, when you do something that increases gains, you inherently take on more risk. This is the opposite. You reduce risk dramatically and get more gains. Now, how much risk? Well, another graph from the study. We've got the coordinated withdrawal strategy with the absolute lowest risk. Next lowest was the last resort strategy, and by far the highest risk was securities alone. No withdrawal strategy. The difference? A 700% reduction in risk. So why wouldn't you do it, right? And here's a quote from my co-author, Dr. Barry Sachs, from the study. He said, the financial advisor can assist the client in using home equity as a buffer asset to minimize the risk of large losses. It's not much of a stretch to include the retiree's risk of cash flow exhaustion as a risk of large loss within this meaning of this section of ERISA. Okay, Dr. Sachs was an ERISA attorney for 25 years and teaches continuing education for Harvard Law. So that is the coordinated withdrawal strategy. Now there's another tool that you want to keep in mind. And this one is really fascinating. It's the first really new innovation in the mortgage space in at least 20, maybe 30 years, right? It's called Equity Select. And it is literally a revolutionary new way to access home equity with ultra low monthly payments and a repayment flexibility that clients want in both first and second lien positions, right? So how does this work? First of all, what I want you to keep in mind, maybe you're in insurance or if you're a tax professional, or regardless of your area of expertise, how many clients do you have that do not move forward on a product or suggestion you have because they don't want to spend the money, right? Even though they know they should probably do it, right? This happens a lot in insurance. Let me give you the result of this product, and then I'm going to back it up with how it works. So the first part, sorry, I have a pop-up that keeps delaying my advancing. We had an actual client. This is an actual client scenario. We've changed the face to protect the innocent, who was turned down by their local bank for a $200,000 HELOC, standard HELOC, due to debt to income ratios. He had great credit. He was looking at adding a $1,250 a month interest only payment. Okay. And they said debt to income ratios were too high. We approved him and funded an $800,000 HELOC with a payment starting at just $667. So payment 4 times the money, and a payment that was a fraction of the payment the bank was going to offer him. Now, how can we do that? Well, let's do an apples to apples comparison. Okay. Traditional HELOC to the Equity Select HELOC, $800,000 home value on each side, $200,000 loan amount. Costs are basically identical. There is no MIP like in a reverse mortgage. So that's another reason why the closing costs are exceptionally low. And then the minimum payment on the HELOC would be 418, and the minimum payment on our loan starts at just 167. Now, how are we able to do that? Well, as I mentioned earlier, we reinvented payments on HELOCs. So here is an overview of our product guidelines, and I want to point out just a couple of things to demonstrate how we're able to do this. The first is we offer payment options every month. Every month they have the option to make a minimum payment, an interest-only payment, a fully amortized payment, or any payment they want above that every single month. Okay. Now, the minimum payment they commit to at the beginning of the loan, and it's either 1, 2, 3, 4, 5% of the loan balance, whatever the loan balance is. Now, the reason we give this option at the beginning of the loan, not every month, is the higher they'll commit to in a minimum payment, the more money we will lend them. And I'll demonstrate that, right? If 1% gets them enough money, then they generally take the 1% because that's the most possible payment, right? The other part of this is the expanded debt to income ratios. We can actually use the line of credit we're giving them to help them qualify for the loan. And there's no recast, and it has a 40-year amortization. You put all this together and you get Equity Select, right? Now, if you have a long time experience in the mortgage industry, you might begin to recognize that this is starting to look like something we used to call a pay option arm back in the 1990s, early 2000s, right? And those products allowed a minimum payment option. But a lot of people had trouble with those loans because there would be a big balloon payment at 5 or 7 years, something like that, and they had to catch up their loan and often didn't have the money to do it, right? And so they would have to sell their house or get foreclosed on. And of course, the media did what the media does, and they said, "Oh, negative amortization loans are bad," right? And it wasn't the negative amortization; it was the recast that was the problem. It was the big balloon payment along the way. We don't have a recast, right? They can keep this loan for 40 years if they want. Most likely, they won't be on the planet in 40 years, right? Because this is something that works for older borrowers. Typically, the older you are, the more money we will lend because we know that loan will be out there for a shorter period of time, right? So I'm going to give you some examples now. Let's go back and finish up our first illustration on the $200,000 HELOC. You'll notice the interest rate is similar. We're slightly higher. Okay. What's important to understand about interest rates, by the way, is that up here, this difference is nominal, right? If we were comparing years ago a 2% to a 4% interest rate, holy cow, that'd be a huge difference, right? Or even a 2 to 3% interest rate. That'd be a big difference in payments because that's like a 33% increase in your payment amount, right? Here, the difference between this and this is nominal. You're not even really going to notice it. Initial payment over here on the regular HELOC, 1458, 167 on the 1% plan over here. Cap payment, none. It's going to recast at 1767. So that payment's definitely going to go up. And ours is capped. So what happens is when they make a payment less than interest only, we're simply going to throw the difference into the loan balance. We're essentially allowing them to finance payments. And since that loan balance is gradually increasing and the payment option on this is 1% of the balance, that means their payment is creeping up every time they do that. And creep is a really good word because in most of the scenarios I'm running, it's taking 5 to 7 years to reach the capped payment, and then it never goes higher, right? So even the cap payment is a fraction of the regular HELOC payment. For basically, somebody's monthly Starbucks budget, they can access $200,000 to do something, right? So why wouldn't you do equity select over a regular HELOC and just have those payment options? So as I mentioned, age is a factor. So let's look at that first. If we have a borrower age 65, property value 750,000, they choose the 1% plan. We're going to give them a 35% loan to value and a credit line of over $250,000. Now, if you haven't worked with this age group in financing before, what you need to understand, because younger people will tend to think, well, gosh, that's not going to get them very much money, 35% loan to value. In America, we are not known for being great savers. We are phenomenal at paying off our homes going into retirement. Almost 65% of American homeowners that are retired, their home is free and clear. There is no mortgage. So in most of our situations, we're looking at borrowers, they're going to get this full $250,000 with a starting payment of just $109. So now let's look at the same scenario with an 80-year-old. Here was our 65-year-old here, right? And now we're going to look at the same 1%, same property value for an 80-year-old, and they're going to get a 47% loan to value. They could have a credit line up to $352,000 and a starting payment of just $148 a month. And now we look at our payment options. If they decide at the beginning of the loan, as I said, if here we got a 65-year-old with a $1.5 million property, if $500,000 is enough money, then they'll generally take the 1% plan and have a starting payment of just $218 a month, right? And then they have $500,000 to do something with. But if they need more money, they can choose a higher payment option at the beginning of the loan, and we'll lend them more money. Here's the same plan for an 80-year-old $1.5 million property. That 35%, excuse me, 35% loan to value, I believe. Over $700,000 in a starting payment under $300. Now you're getting into a realm to where it's like, maybe they want to be a real estate investor, and they could take out the credit line on their house and then write a check and buy a rental house and have this little bitty payment. Don't have to worry about, the non-owner occupied, functions and things like that. The other thing to notice is that the closing costs are much lower on Equity Select. They're lower than a HECM reverse mortgage and even lower than a proprietary reverse mortgage. And then the payoffs are lower the further out you go on the loan, because they are making some payments. And so more is left to the heirs with the Equity Select than a reverse mortgage. But again, it just depends on what are the client's needs and wants, and what do they feel is best for them. If they want absolutely no payment, then maybe the reverse mortgage is the way to go. So using Equity Select, one of the first areas I thought of as a financial advisor was with my business owner clients, right? Business owners have been getting slammed with these high interest rates. They often have credit lines that are interest only and adjustable rates. And so what they could do, if they have a high rate, high payment business loan, which is affecting their profitability, and they have equity in their home, they could take the equity out of their home with Equity Select, pay off the bank, and then have the business make payments to them. And then, if you're a tax professional, you're looking at this going, oh, that's interesting, right? That opens up some possibilities. And then now you can also make sense to finance certain financial products. What we've done inadvertently in creating this was we gave homeowners the same time money arbitrage that insurance companies use. It wasn't our intention. We were solving for high payments, how to make low payments that people can afford. Right? So an insurance company receives premiums, and then they buy time by restricting the use of the policy for a period of years or something, typically. And then they invest those premiums, and their goal is to make more money in the investments than they pay out in benefits. That's fundamentally how an insurance company works. Well, now for homeowners that have equity, they can buy time and access with Equity Select with an ultra low payment obligation, and then purchase a financial product that makes sense for them now. Maybe a product they couldn't afford otherwise. and then they gain that benefit and fill that financial planning need. So one of the areas we discovered this works really well at is long-term care insurance. The market for long-term care insurance is, for the last 20, 25 years, has been almost exclusively for high net worth individuals. And so if you're not familiar with long-term care insurance, it's because nobody's marketing it, to the broader market. And so now the products the wealthy are buying, the average American homeowner can afford those now too. And why would you do that? Well, if we had a single female age 72 puts $100,000 into a long-term care insurance policy, an asset-based policy, she's going to get a lifetime care benefit with that. So that's lots of financial security and a death benefit if she ends up not using it for care. Right? That used to be the old problem with selling long-term care insurance, was you could pay into it for years, just get hit by a bus, never use the policy, and all that money went for nothing. Right? But with this death benefit, you're going to get one or the other. You're either going to get something that pays for your care, or your heirs are going to receive the death benefit. So the 100,000 turns into 126,000, tax-free, probate-free. But she also gets a lifetime care benefit if she needs it, capping out at $52.66 a month. So how does the homeowner finance that? Well, if you have a home value $800,000, we could give her a line of credit of $257,000. She uses 100 of it to purchase the policy, and then she has the remaining line for everything else she might need. Home improvements, make her home more senior friendly, put in a walk-in tub, whatever it might be, a new roof. Her minimum payment will start at $120. And she gets all that, right? And the financial security of knowing she's not going to get wiped out by care costs that could be 6 figures a year. And so if all she wants is enough to get the policy, we could actually lower the credit line from the 257 to just the 100,000 plus closing costs, and her payment's probably going to start at about $87 a month is all. Accessing a policy that the wealthy drop $100,000 into cash. They do it all the time. Okay. If we looked at a couple and their care path that starts off with 4 years in-home care, followed by 2 years of assisted living, 2 years of nursing home. Of course, it could be all kinds of variations. But if it were this, the policy would pay the $250,000 for the couple's care in-home care. And by the way, data proves that if you get your care in-home and frequently as you need, you live longer. It extends life expectancy. And so how that would look for the couple, they'd buy a $172,500 policy. They're going to get a payout from that policy to pay for care of $52.68 each, and then make minimum HELOC payments starting at just $154 a month for 7 years, and then sell the house for $1.3 million. So 3 years before they needed in-home care, they bought the policy. They paid on it for 3 years, these little bitty payments. Then they started utilizing the policy for 4 years. Then they sell the home, move into an assisted living facility for 2 years. At a cost of $192,000, the policy covers all that. And then into the nursing home for 2 years, and the policy pays over $250,000 of that expense. And the couple pays $163,000 out of pocket for the difference to cover the total cost of the nursing home. Now, could they take out a larger policy that paid for all of that? Yes, absolutely. But I'm going to show you in a moment why this is the ideal scenario. Okay, why you would actually come up a little bit short. So before we go there, when they sell the home, they sell it for $1.3 million. They pay off Equity Select. They also use the proceeds to pay their out-of-pocket costs in the nursing home, and they saved $250,000 on in-home care, leaving over $1 million, $1,088,000 to their heirs instead of just $458,000 without a policy purchase. Because here they ended up, we're assuming they had the money or assets to pay for in-home care, and then the house proceeds paid for everything their minds 458, but if they had bought the policy, they'd leave them over $1 million. So now we do a little financial planning, and then we sell the home. That's now liquid assets that move over to a wealth manager, $1,038,000 in assets under management, while they're in the assisted living and the nursing home. And all we can do whatever we want, whatever the financial advisor deems is appropriate. But in this case, they just put it in 1-year T-bills. So when they do that, they invest the money in T-bills. Now they have state income tax-free T-bill income that offsets the nursing home expense, and they end up leaving $1.26 million to their heirs versus $458,000 without a policy, right? So that's why you don't buy a policy that covers all the care normally, because you have to factor in investing the proceeds of the sale of the house, and you don't need to, and you come out even further ahead. All right, so now that addresses the market for long-term care insurance that gets on the fence and usually falls off, right? Like if you're wealthier than that, no problem. Those people have no trouble putting $100,000, $200,000 into a policy. It doesn't affect their life one night. They don't lose any sleep over it, right? But now we bring this down to the average American homeowner that most of their wealth is tied up in their house, right? Let's look at a house that's worth $575 and they do the same thing, right? They didn't have the money, by the way, even for the in-home care out of pocket. And when they sell the house, $380,000 transfers to a wealth manager to invest it in the 1-year T-bills. This family ends up leaving $340,000 to their heirs versus nothing, right? They didn't have the money for in-home care. They were going to probably have to sell their house sooner, go through the process of spin down and qualifying for Medicaid and so forth, if that is even an option. And then here, the policy paid for this, and they leave $340,000 to their heirs. I would venture that this is more impactful to this family than the $1 million the wealthy family left to their heirs. Okay, so what this does is expand the market for long-term care insurance to millions of homeowners. Let me show you some interesting math right here. 4 years of in-home care self-pay, $24 an hour, average cost. If you live in California or Florida, it's more like $35 an hour. Easily $200,000 for a couple, at least. That's a really low number, actually, if you're in California, right? 4 years of in-home care self-pay. Compare that to 7 years of Equity Select minimum payments. We're talking about cash flow here, right? Actual out-of-pocket stuff. Only $17,000 out of pocket. But this $17,000 didn't just pay for in-home care. It got them a policy that was going to pay for all of their assisted living and most of their nursing home. So some Florida data. There's 620,000 homes in Florida that are valued at $1 million or more. 1.1 million homes valued at $500,000 to $1 million, and nobody is selling long-term care insurance to these people because they don't think they can afford it. Now they can. In California, 1.7 million homes valued at $1 million or more. Over 4.2 million homes between $500,000 and $1 million. And again, nobody's selling long-term care insurance to these people either. But now they can. So again, we mentioned this already. The typical single premium client, is liquid $500,000 to $1 million. That's beyond investable assets. So they don't lose sleep putting $200,000 into a policy. But the new market for long-term care insurance is people that need it most. Age 55 to 85, home value 400,000 plus, little or no mortgage. U.S. seniors hold $14 trillion worth of home equity, is the largest home equity demographic in the United States. And what this means is that we have created a blue ocean moment for the long-term care insurance industry. Okay? We've already announced partnerships with insurance companies that are pursuing this. Okay, what is a blue ocean moment? It's the creation of a new untapped market where competitions are relevant, offering significant growth potential. Past examples, when Apple invented iTunes and the iPod, reinvented music, reinvented, accessing the internet remotely. Domino's Pizza came into a 300-year-old pizza industry, added quick delivery, and became the largest pizza company in the world. 2009, Uber reinvented taxis. Amazon, 1994, reinvented shopping, right? So the sale looks like this. The insurance agent educates the client as to the need of and cost of long-term care. If they are talking to a typical high net worth client, nothing changes. Agent demonstrates the impact of LTC on their legacy goals and heirs. That's why the high net worth take out these policies. They want to leave more to their heirs and not have care costs eat that up. And so the agent qualifies them for the policy. But now with this new market, the housing wealth market, the agent takes an extra step, demonstrates how long-term care costs reduces housing wealth and the impact on their family care providers, because very often family members get burdened with helping with care, either with cost or actually doing it. And then the agent checks home value, existing mortgage amount, and age to see if Equity Select might work. Okay. Is there enough equity in this house? Right. And then the agent qualifies for them for the policy. And then after that, the client calls the loan officer that invited you here today, to qualify for Equity Select. Lender processes the loan, orders the appraisal, loan's underwritten. If approved, client typically receives their fund in 2 to 4 weeks. They pay the insurance premium, writing a check out of the checking account. And then the advisor or agent writing the policy gets usually an 8% commission. It's a really strong commission. And then a few years later, the financial advisor receives the home sale proceeds as new assets under management. So the Equity Select loan, what we have learned by introducing this to the insurance industry is it not just opens up the opportunity to sell long-term care insurance to millions of people, but then opens up the opportunity to sell other policies along with it. Medicare supplements, bridge medical plans, if somebody's retired early and not qualified for Medicare yet, final expense plans. And then, of course, we usually qualify them for more than they need for those things. And so they can do some home improvements, pay off credit cards, do whatever else they want to do, all in one loan with an ultra, ultra low payment.